If you're looking to invest in stocks that provide a consistent income stream, then dividend stocks are the way to go. But how do you determine which ones are the best? Let's find out. Here are 7 foolproof criteria to look for when considering a dividend stock. First criterion, dividend yield. Dividend yield is a fundamental criterion for identifying top dividend stocks, serving as a key metric in evaluating the income potential of an investment. The yield is calculated by dividing the annual dividend per share by the stock's current market price. However, achieving an optimal balance between yield and risk is paramount. While a high dividend yield may seem attractive, it could signal financial distress for the company or an unsustainable payout ratio. Therefore, investors should assess the stability of the dividend and the overall financial health of the company. Setting realistic expectations is equally crucial in the context of dividend yield. Investors need to recognize that excessively high yields may come with higher volatility or a potential decline in stock value. It's essential to consider the sustainability of the dividend payments and whether the company has a track record of consistently meeting or increasing payouts. A sustainable dividend yield provides a more dependable income stream for investors, contributing to long-term financial stability. Investors should also compare the dividend yield of a stock with industry benchmarks to gain insights into its competitiveness. Additionally, understanding the company's dividend policy, historical trends, and potential for future growth is essential in forming realistic expectations. By carefully balancing yield and risk and setting pragmatic expectations, investors can identify top dividend stocks that align with their long-term financial goals and contribute significantly to a robust and reliable income stream for early retirement planning. Second criterion, dividend growth history. A crucial aspect in evaluating top dividend stocks is their historical dividend growth. Consistency in dividend payouts reflects a company's commitment to returning value to its shareholders and signifies financial stability. A track record of uninterrupted or growing dividends demonstrates the company's ability to generate consistent earnings and cash flow, providing investors with a reliable income stream. Assessing the consistency of dividend payments over several years offers insight into the company's resilience during various market conditions and economic cycles. Reliability is equally essential when examining a stock's dividend growth history. Investors should look for companies with a dependable pattern of increasing dividends, preferably at a rate that outpaces inflation. A reliable dividend growth history is indicative of a well-managed and financially sound company that allocates profits wisely, fostering investor confidence. It showcases the management's commitment to creating shareholder value and can be a key indicator of a company's overall health and long-term sustainability. Third criterion, long-term performance. Beyond consistency, the long-term performance of a company's dividend growth is a critical factor for investors seeking stability and sustained income. A stock with a history of consistent and meaningful dividend increases over an extended period is likely to provide investors with enhanced purchasing power, preserving the real value of their income against inflation. Long-term performance in dividend growth also aligns with the goal of building wealth over time. Companies that can maintain or increase dividends consistently demonstrate financial strength, strategic foresight, and a commitment to shareholder interests. Evaluating a stock's long-term dividend growth performance enables investors to make informed decisions about the potential for sustained income and capital appreciation, contributing significantly to the success of an early retirement portfolio. Fourth criterion, financial health of companies. Evaluating the financial health of companies is imperative when selecting top dividend stocks for an early retirement portfolio. Earnings stability serves as a key metric in this assessment, indicating a company's ability to generate consistent profits over time. A track record of stable earnings reflects a well-managed and resilient business model, reducing the likelihood of dividend cuts or interruptions. Investors should scrutinize the company's income statements, looking for a history of predictable and growing earnings. Companies with a stable and upward trajectory in earnings are better positioned to sustain dividend payments through various market conditions, contributing to the reliability of the income stream. Fifth criterion, debt management. Another critical factor in assessing the financial health of a company is its approach to debt management. High levels of debt can pose a significant risk to dividend sustainability, as excessive financial obligations may impede a company's ability to meet dividend obligations during challenging economic periods. Investors should examine a company's balance sheet to understand its debt levels, debt-to-equity ratio, and the overall debt structure. Companies with prudent debt management practices, such as manageable debt levels and a healthy interest coverage ratio, are better equipped to navigate economic downturns without compromising dividend payments. A low debt burden enhances financial flexibility, allowing the company to allocate funds to dividend distributions, supporting a stable and attractive income for investors. By carefully considering both earnings, stability, and debt management, investors can gain valuable insights into the financial robustness of a company and make informed decisions when constructing a dividend-focused early retirement portfolio. Part 2. Building your ultimate dividend portfolio. Now let's talk about diversification strategies. Sector allocation. Diversification is a cornerstone of a well-constructed dividend portfolio. Sector allocation involves spreading investments across different industries, reducing the impact of poor performance in any single sector. By strategically selecting dividend-paying stocks from various sectors, investors can mitigate risks associated with sector-specific downturns and capitalize on opportunities across the market. For instance, combining traditional sectors like utilities and consumer staples with growth-oriented sectors such as technology can create a balanced portfolio that thrives in various market conditions. Geographic diversification. Geographic diversification adds another layer of resilience to a dividend portfolio by investing in companies from different regions. This strategy helps navigate global economic trends and mitigates risks associated with regional economic downturns. A well-diversified portfolio may include companies from both domestic and international markets, providing exposure to different economic environments and currency fluctuations. Balancing risk and reward. Conservative versus aggressive approaches. Achieving the right balance between risk and reward is crucial when building an ultimate dividend portfolio. Conservative investors may prioritize stable, established companies with lower volatility, focusing on preserving capital and generating reliable income. On the other hand, more aggressive investors might seek higher yields from riskier assets, accepting the potential for increased volatility in pursuit of greater returns. Tailoring the portfolio strategy to align with individual risk tolerance and financial goals is key to long-term success. Incorporating growth stocks. Balancing a dividend portfolio involves incorporating growth stocks alongside established dividend-paying companies. Growth stocks, often from sectors like technology and healthcare, can contribute to capital appreciation and enhance the overall total return of the portfolio. While these stocks may offer lower current yields, their potential for future dividend growth and capital appreciation can provide a dynamic element to the portfolio. In conclusion, building the ultimate dividend portfolio requires a thoughtful combination of diversification strategies and risk-reward balancing. Investors should tailor their approach based on individual preferences, risk tolerance, and financial objectives to create a portfolio that aligns with their vision for a successful and sustainable early retirement. Part 3. Maximizing returns with dividend strategies. Reinvesting dividends. Reinvesting dividends is a powerful strategy for maximizing returns in a dividend portfolio. Instead of receiving cash payouts, investors use dividends to purchase additional shares of the same dividend-paying stocks. This approach leverages the power of compounding, as the reinvested dividends generate more shares, leading to an exponential growth in future dividend income. Over the long term, this compounding effect can significantly boost the total return of the portfolio and accelerate wealth accumulation. Tax-efficient investing. Tax efficiency is a crucial consideration for investors aiming to maximize returns. Holding dividend-paying stocks in tax-advantaged accounts, such as individual retirement accounts, IRAs, or 401ks, can help defer taxes on dividend income until withdrawal. Additionally, focusing on stocks with qualified dividends, which are taxed at a lower rate, can enhance after-tax returns. Implementing tax loss harvesting and strategic asset location strategies further contributes to tax efficiency, allowing investors to retain a larger portion of their dividends. Creating a sustainable withdrawal plan. A sustainable withdrawal plan is essential for investors in or approaching retirement. Establishing a well-thought-out withdrawal strategy ensures that retirees can generate income from their dividend portfolio while preserving the portfolio's longevity. This plan involves determining a reasonable withdrawal rate, considering both the current income needs and the need for the portfolio to last throughout retirement. By aligning withdrawals with the overall portfolio strategy and market conditions, Investors can strike a balance between meeting immediate income requirements and ensuring the sustainability of the portfolio over the long term. In conclusion, maximizing returns with dividend strategies involves the dynamic interplay of reinvesting dividends, tax-efficient investing, and creating a sustainable withdrawal plan. These strategic approaches not only enhance income but also contribute to the overall growth and resilience of the dividend portfolio, supporting the financial objectives of investors throughout their investment journey.